Thank you for joining us. We did think instead of the usual sort of periodic update, it might be helpful to actually properly set out what it is that you're getting with Phoenix. Do you want to? Because we talk about the topical things each period, but just backing up to what Aurora is, and what the Phoenix approach is. We've been managing Aurora now for 10 years, since 2016, but our history goes back to 1998. And what I want to try and do today is bring to light the machine that sits behind that. We managed 1.8 billion. Aurora was 15 million when we took it on, and it's about 300 million today. I do just want to mention Howard Flight, Lord Flight, who was the chair of the trust when we took it on. He passed away sadly at the weekend. We wouldn't be here managing Aurora if it wasn't for Howard. He's one of those people, founder of Guinness Flight, but one of those people whose brain never gets old, endlessly curious, and we are very odd, as you're about to hear. And he had the breadth of mind to get us enough to realise that we could potentially do a good job for Aurora. This is the only way into Phoenix, the only public way to invest in us and to back our strategy is the investment trust. And we manage other segregated accounts and mandates, all with the same strategy and the same portfolio. But money we earn and fees and other different structures all aim to earn the same amount, allows us to offer something quite unique in Aurora, which is we don't get paid unless we outperform. We only get paid a performance fee out of outperformance, so one third of alpha, and that's in a year, and it sits there for 3 years. It's not for us to be able to touch, and if that performance is not there 3 years later, then we lose it. And I think that means we should be cheaper than an index fund, because if we match the index, we don't get anything, and on a net basis, we'll always be cheaper, because we get paid out of your outperformance. So that said, in the 10 years, that hasn't changed. In the 10 years since we've been managing Aurora, it doesn't look very different from the index. So either we're fools for taking on the mandate in that way, and we've lost our edge, or what I think has happened is you get an ebb and flow. And when we explain how we work, you'll see that it ebbs and flows, and those ebbs and flows can be quite big. And on the next slide, if you look at our long-term record, we have delivered alpha, even with the recent suppression. So 5 points. So this is the UK fund, our flagship fund, same strategy, same portfolio. That's Aurora, going back to when we started in 98. And this is gross, because that's how Aurora is. This is on the no fee for performance fee basis, delivered 5 points of alpha, and through time that compounds. You'll see the drawdowns there. So the way that we invest is prone to big drawdowns, but almost all the drawdowns have reversed within a year, and all of them have reversed within 20 months, which is faster than drawdowns in the market. And in fact, drawdowns are the source of our future alpha. But if you're the sort of person who would potentially redeem or lose nerve and sell in that type of drawdown, then this is not for you. So just turning to that thing about alpha, it does ebb and flow. And when the portfolio cheapens up and gets more and more attractive, then we can underperform and the alpha can go away. And that's the rolling 10-year alpha. And so great for anybody looking at it today, but it's been a drag over the last 10 years, or lack of alpha. In a nutshell, our goal is to deliver high returns with low risk. And we call high returns 15% per annum before fees over the long term, and low risk. And when we think about risk, we're talking about the potential for a permanent loss of capital. We're not talking about share price fluctuations, as you can see. We take noise, but we think of real risk in terms of permanently losing some of your capital. And everything we do is targeted at that goal. We're very long term. So although 10 years might seem a long term in the way that we think, it is maybe medium term. And when you think very long term, small differences of returns compound into very large differences. So here's compounding at 7.5, and compare it to compounding at 15. You know, it's nearly twice over 10 years, barely noticeable, but through time it magnifies and magnifies, and you see that in our 28-year almost 28-year record. So we have a investment framework that is geared towards generating high, very long-term returns, accepting the noise that comes in between. So I'm going to try and explain the framework. We're value investors in the traditional sense of the word, influenced by Ben Graham, the founder of the school, and Buffett and Munger, and particularly Phil Fisher in our regard. We apply a proprietary framework that actually pays more homage to Kahneman and ilk in the field of behavioral psychology and behavioral finance. And then the tools and techniques that we use to do this are themes. They're proprietary. And I'm going to try and take you through some of those. And those are increasingly being augmented by AI. At the heart of everything we do is the investment team, 10 people. It's a very unusual structure for anybody from outside. Designed particularly to achieve our goal, truth-seeking, independent thought. They are totally unmanaged islands of independence. We would put figuring things out correctly over efficiency. So independence over collaboration, because we're trying to avoid a groupthink. And at the heart of everything we do, all the information we arm ourselves and the way we're designed to do it is what we call a Socratic process. It's a discussion aimed at seeking truth. Let me just take you through some of the steps. The first step in risk management is to avoid the things that you shouldn't own. And so we're very, very particular in what we look for. And we have a way of describing that type of investment, and it's written down in a manual, and the manual is called DREAM, Dynamic Relative Evaluation and Assessment Model. It's now 125 pages of size. So everything we're looking for has got to fit into that, but we're looking for, we call them great businesses. Great businesses can earn a 15% return on what we call real capital, and return meaning real cash, in a sustainable way, which we understand and can observe in action, and which is run by people who are honest, competent, and aligned. And there's a particular price that we want to pay, which I'll come to. So DREAM defines the type of business that we're looking for in a very specific way, and we do this again and again. So we can build expertise through time, through a feedback process. So DREAM has been used now for 26 years. So that allows us to assess and see what we would call, whether it's a AAA. But it takes us so long to do that we can't wait for AAA. In other words, good business, good management, good price. So what we do is seek out businesses that are double A's, where it's the business passes our assessment, and so does the management. And then we worked out the price at which we would act. So building out double A's gives us a pool of potential investments, and then the rest is a kind of up to the market to present us with the opportunity to buy what would be an extraordinary a good price. And then before we come to invest, we have a risk checklist. And this is because although you have an assessment model, there'll be factors that are idiosyncratically important to a particular business that are a reason not to invest. So you can get through the assessment, but you maybe shouldn't invest. And the checklist builds through time as we learn from errors, and it is, again, it's a way of building that filter to keep out the mistakes. Having passed through the filter, we will invest. And when we're working out what we invest, firstly, from a price, what price we'll invest at, the price needs to be half, no more than half what we think the business is worth, but also no higher than what we think is a worst case outcome. So in other words, we want to invest with an expectation that we won't lose money. But if we're correct in our assessments, we'll make 15% per annum. And then when we are investing, we use a portfolio construction approach that reflects a confidence nod, which we'll talk about, and we'll call it Kelly sizing, Kelly influence sizing. And Carter's going to take you through that in a bit. And then a lot of the work happens, and a lot of the work we do, and most of the work, I would say, is monitoring what we own. So we only invest in businesses that we can see in action. So that's consumers in action, customers in action. It's competitors in action, and changes in the business model. So we run monitoring programs on our investments. We avoid investments where we have to rely on management to know how we're doing. We independently monitor, and that provides our next level of risk management. All of this is done in a way to take out bias. So we recognize that as humans, we're not instinctively wired to make sound investment judgments. And our framework is designed to take out as many human biases as we can, but also do it in a way where we continuously improve. So Kahneman and Tetlock have their famous debate about expertise, where Kahneman says there's no such thing in financial services. Tetlock does, and he spent his time, Klein, not Tetlock, Gary Klein. He spent his time studying people like chess players and people who've got very contained domains, and they agreed you could have expertise providing certain things were in place. So a robust feedback loop and an ability to repeat. So we've designed our framework in as much as a way to be able to build expertise through time by doing the same thing in the same way and then learning from what we do, leaving enough of a trail of information to be able to learn lessons after the effect and improve the system. Just to give you a sort of glimpse into this, these are the sort of top level items in a business dream. This is an earlier version of Nothing's Dream 6. The latest dream has culture in there and stuff. But every one of these factors, the manual calibrates how you should think about them and how you should score them. So no matter which business you're going, you should be able to read the description of the factor, and then it tells you how to score it. One of my observations of people, especially value investors who have a conservative bent, is that they compound conservatism. And quite often that's because they haven't done the depth, or they haven't got the confidence, or Dream separates those out. So it liberates you to put the right assessment down by acknowledging that you don't have the depth of work, or that you lack some confidence. All of these assessments are individual. They all require a discussion amongst at least two people, usually three, on a factor, and we'll spend a lot of time, one meeting only, on one factor, figuring these out, and that builds up to a weighted score. And the weights, again, they're not multiplied. A lot of that conservativeness comes from people handicapping conservativeness, multiplying, then they don't realize how conservative they've been. We leave our conservativeness to the price we pay. So these factors are, rather than multiplied by each other, they're weighted and averaged. We haven't shared the weights, but the weights reflect the biggest weight for the most important factors. And just to give you sort of a flavor of the risk checklist. So yes, something may have passed, it may be a AAA, but before we put it into the fund, this is the final opportunity to stop something going in. It's the final filter. And this filter's got bigger and bigger over the years because we've made plenty of mistakes. So it'll be something to identify. When we invested in Hornby for the first time, we did not realize that all their products were made by one supplier in China, which is incredibly leveraged and vulnerable. And that led to an enormous amount of damage and problems. And it ended up in the hands of a competitor. So unfortunately, that wasn't on the risk checklist when we made the investment, but it is now. And so it builds through time from lessons learned, but it makes you apply all of these and work out whether they're a red flag. Regulatory risk for some investments is not material, but for some, it's the reason not to get involved at all. Some of the factors are business factors, and some are behavioral factors. After investing, we build something called a roadmap, an idea of an expectation of what's going to happen for that business. And because although we use single numbers in spreadsheets, we never expect single numbers. We expect ranges, and you can run various scenarios. But the roadmap allows you to think of the world in ranges, and laying it down at the beginning of the 10 years in terms of what it is to do sales or profitability or what management will do or capital structure allows you to look at the world and ask yourself, is it on or off road? Is the world unfolding in a way that we assumed when we valued this business and made the investment, or are we off roadmap? And if we're off roadmap, it's an amber light. Do we need to reconsider our views and our assessment? And then we're constantly looking for evidence. So here's something from our monitoring program from Wetherspoon. So when we first started investing in Wetherspoons, this monitoring program would have involved, we used to pay students to go into pubs, fill out our information sheet, and then send us a menu. But now we can use increasingly sophisticated methods. So 18,000 Google reviews. We trawl for one of the factors would be value for money. And this one shows that between the two measurement points, there had been a deterioration. And then we drill down to the tail where that's happening. And then we identified it was in the franchise pubs. And then we have something to look at and say, what's going on here? Is the business losing a key element of our assumption about what it was about, a value for money? And this is the monitoring programs in action. And to give you an example of another company where that would have been a useful warning is this is Primark for ABF over the last 5 years, so 31,000 reviews, and it was having a deteriorating value for money perception. And given how important value for money was as part of its proposition, eventually that's resulted in profit warnings. But if you've been looking at a monitoring program like this, you've just seen it before the market, before management told you about it. And that's what the monitoring programs are about. Are the key assumptions we've made about the business, are the assumptions made being borne out by what's happening? Is the world unfolding in a different way? Are things shifting? Can we pick them up and move beforehand? So on that note, I'm going to hand over to.
So I was just going to give you a bit more color on how we think about and approach portfolio construction, because I think the output of it is something that makes the portfolio quite different. I thought I'd explain the theory here and how that influences what we do in practice, which is if you were trying to work out how much you should stake on a position, knowing that you have a return that's possible, but also that there's a probability that you're wrong. There is a theory for this, which is called Kelly criteria, and it's been popularized or it's been written in books like Fortune's Formula or The Missing Billionaires. And really, it's about what should you do if you have something like a biased coin toss, so a bet that you can make repeatedly over time, what is the optimal way to stake your position in order to grow your wealth. And the way you can think about it, and it's probably best illustrated in an example, is the amount you should stake is a function of your advantage. So that is the difference between how much you make when you win versus how much you lose when you don't, and divided by the payoff. So that is how much you get in that winning formula. And the easiest way to explain it is if you had a 50-50 coin toss. So if you were betting your wealth on a 50-50 coin toss, it wouldn't be rational to bet anything because it's purely luck. That bet has no positive expected value. Whereas if you look at the bottom, if you were sure that every time you flipped the coin, it was landing heads, you could stake all your wealth every single time. And what the Kelly is really useful for is something in the middle, where you have an advantage, but it's not 100%. And it tries to answer the question of how much should you stake? And again, that point about advantage over payoff, if you look in the example of 49%, your advantage is 2%. That's the difference between the two numbers. And your payoff is 1 times. And so the Kelly says you should bet 2%. And the interesting thing about this formula and what it's solved for is what it shows you is that as the probability, as your advantage increases, your bet size should increase in a non-linear way. So in this example, you can see that if you go from having a 51-49% coin toss to a 60-40, the amount you would stake in a bet actually rises from 2% to 20%. And I just thought I'd actually do a simulation to show you how that works. And one of the ways we were talking about it, which is maybe a way to simplify it, is you can almost equate this to thinking about if you wanted to grow a plant, how much should you water it by? And you can think of it in different terms as being a timid Kelly or a small bet being not giving it very much water, and a large bet as being really very aggressively watering it. And here, this shows you with the 60-40 coin toss, what would happen if you started with £100 of wealth and you were to flip the coin 200 times, simulate 5 scenarios for each of the different betting strategies. And what you see in here on the green line on the top right is the Kelly, the median Kelly outcome is the one that maximizes your wealth over time. And that's because what the formula is effectively doing is it's balancing your advantage against the risk of ruin. And what you can see is effectively, as per that analogy, if you're too cautious in how you bet, you don't maximize wealth. If you're too aggressive, you risk ruin, even though there'd be a tiny number of scenarios where you do actually end up with the highest outcome. But what you find and what influences our approach to how we use the Kelly is actually that there can be a balance in between this theoretical amount that you should be betting, and something in the middle, call it here a half Kelly, that actually best minimizes the volatility, that is the fluctuations in your wealth along the journey. Now, I apologize if that was slightly complicated, but the really key implications it has for the way we approach the portfolio is you can see it in 2 ways. Firstly, when we're highly confident that there isn't a scenario where you can lose money in a position, i.e. you have a very high advantage, it's like 100%, it's like a coin toss where you know what the outcome is, you can afford to bet very large. And 2, what you can see in the way our portfolio is sized is the difference between the largest positions and the smallest positions reflects the fact that we do have a range of conviction in our holdings, and often that will come from being early on in the knowledge gathering exercise.
So what I would just say on Kelly is, remember what Kartik said, it's a single bet at a time for a single coin toss. That's not how portfolios work. You have to run them all at the same time. And there isn't a mathematical solve for a portfolio. So mathematically solved for a single bet, but we have indeterminate time periods, and the payoffs aren't as clear. So Kelly informs the thinking behind it, but actually has to be applied specifically for portfolio management. So if you looked at some of our individual investments, the actual Kelly answer will be much bigger than the portfolio weight that we have. But we have to recognize fairly sequential, whilst we were running in parallel with the portfolio. The best measure, I think, of all of that together, the filtering for what you buy in the first place, the monitoring program to detect things going wrong or things to be left alone, and the position sizing is this. So this is the strike ratio for the original fund. So winners and losers. So on the left by number, 97 winners, 28 losers. 78% of the time our investments have made money. That's already materially more than the index. But by value, where position sizing matters and monitoring programs picking up errors before they show in the market, it's 93.7. And I think this is a very unusual outcome. And I don't know if there are other managers who have higher ratios. And that's the source of our alpha, and it comes from that system in action. So that's the machine. Trying to show it in action. We have this schematic, which I'm going to take you through, for thinking about the anatomy of our typical investment. And it's got 6 phases, and we'll go through it. But what I want to say is these lines represent the price. They're not right for time, and it's different for different stocks. So unfortunately, it doesn't give you any kind of early warning of when things are about to happen, which you can see by the way we invest. But actually it applies again and again. So in the first phase, shares are collapsing because there's bad news. Analysts are downgrading, things are going wrong. There may be a backdrop of a bad market as well. Burberry in 2024. Taking Burberry going from a £10 billion company to a £2 billion company. Now we can't start doing our work at that point because of how long it takes us. So we're ready because we've done 10 years of prior work and patience to get to that point. But if you're investing in this time, quite often you get to look pretty stupid because you buy something and it halves again. But the more it halves, and potentially the better ultimately it is for you. But it can look quite ugly, and we have no problem about catching falling knives because we rely upon the strength of our diligence to make sure that we're not going to have our fingers cut off. So that's the first phase. And then you reach this phase where the fundamentals are still bad in phase 2. Sorry, I'm just a bit clumsy. Still bad, but the shares have fallen so far, they've got ahead of the bearishness and they find a floor. The bargain hunters are coming in, and you get this sort of sideways period where, yes, it's bad, but it's no longer falling. And then you get this sort of subtle shift, noticed by those who have invested, that the business is improving, the fundamental improve, but it isn't being reflected in the share price. And this can be, it's an out of favor stock, and it's people have dumped it or they got burnt on the first time down, they don't come back to it. And if you own it, you're very sensitive about things. The story seems to be improving, but nobody seems to have noticed. And then at some point, and this can go on for ages, this is very indeterminate how long someone can stay in the wilderness. But then when it does reprice, they tend to happen quite quickly. So think Lloyd's last year. It spends ages in the wilderness around 40p, a decade. And then in a year, it's a pound, 150% up. It's not predictable, but the nature is the same. And these re-ratings often get ahead of the story. So you may have an element of short covering in there. You get people jumping on the bandwagon, and everybody likes a bit of momentum. And quite often that runs ahead of the story. And then you go into the next phase where you've got the fundamentals are still improving, but the shares don't move. And that's a function of the fact it moved so fast in the first place. Those bargain hunters who bought in the lower range are taking profits, and new investors, having seen the change, are starting to come in. and they change hands, and you have this sideways period. And this is the really hard one for people who want to run winners, the really tough test. Because ideally you want to run this all the way through, but right here, when you've reached that point D and the price may be ahead of the story, but you've got a wonderful business, you may be about to spend some time going sideways. It's very tempting to take the money off the table, but ultimately, if you do, you don't make it into the final phase, which is where the business is improving and the fundamentals are improving, and they're sort of moving fairly much in an aligned way. And if you've identified this right, they go on forever. And we look for things you don't forever. We never buy anything thinking about an exit price. We think about it for that forever holding period. It really frames the way we think about things to think in that forever mindset. Very careful about what you own. But when you get to this sixth phase, well, then it just takes care of itself. So if you think about the portfolio at any one time, it's going to be made up of some things coming in on the first phase, things sat not moving. We've got Barrett Redrow now. It's past the inflection point, fundamentals improving, the macro fundamentals improving, the merger's been integrated. It's sat there with its with all that cash and incredibly cheap, but the shares haven't budged. And when will they? I have no idea. They sat from 2009 to 2012 with the shares at £1. And then, in a year, they were £3, a bit like Lloyd's. So you can see we've started to have a bit of a valuation improvement through the Carcino share price. Burberry has raced up, more than doubled from where we purchased it, already beginning to discount the turnaround, which is only just beginning to emerge in the fundamentals. Lloyd's we talked about earlier. It's had to move. It's now reflecting some of that change. Fraser's, which has had a re-rating and then gone sideways for years. The value and all the good stuff's happening underneath, but it's not showing up in the share price. And then you go to something like a Ryanair or a Netflix, that these businesses are doing well and materially above where we bought them, and but they're performing very well, and they're on that line to infinity and beyond. We think in terms of cost price weights. So we think about how much money we put in, less so than the current portfolio weights. And if something's drawn down, we don't just top it up to get it to the right weight. We think we put the right amount in and it's gone down, the weight will have gone down. We own something, we put the right amount in, it's doubled, the weight will have gone up, we leave it be. We let that noise play out, but at any one time, you look at the portfolio and it looks a little odd. It reflects all of these dynamics going on underneath. Oh, sorry. And that's the portfolio as it is today. So when you see those big 15% weights in those holdings, those weights reflect all of the things that we've just said. All of that, how well we know them, we don't use single intrinsic values. We use a valuation horizon. How much downside we have, how much upside, how much confidence we have in that, and how much visibility we have of the things that we think where it could go wrong. And that's all reflected in those ways. The best way to guide the portfolio. So yes, you can look at single stocks, and we will obviously talk about individual investments. But really, the best way to understand the machine is the aggregate, because you get the aggregate return. And we've been publishing every quarter since we started our estimate of the central intrinsic value of all of the holdings in the portfolio. And so for the NAV today of the investment trust, which is £3, share price is £2.79, we estimate £7.11. So 135% upside to NAV, but actually the share price is 155%. And we've got enough data to say, well, what does that mean? Is there any correlation between that measure and what happens next? And yes, there is. Unsurprisingly, when the portfolio is cheaper, it does better. So what the table here shows you that we're at 140 on the NAV. We've had that 34 times in the past I keep saying 28 years. It'll be 28 years on the 1st of May. In the last, so we've had 34 quarters. There's never been a period when you've had that within 3 years where you've had a negative return, and the average return has been 59%, which is 16.7 compound. So this is cheap, not surprisingly, because we've seen that cheapening, that rolling back of the alpha over the last 10 years. That's storing up future value. I often equate this to like a stretched piece of elastic, and this is just the elastic very stretched. But the best guide to what's to come is that, with all the caveats of past returns aren't a guide to the future, I'm supposed to say. So in a nutshell, what you should expect from us, on the left-hand side, volatility of price. We accept that noise for what we're going to get, but it is not for everybody. Drawdowns, not just expect drawdowns. They're actually great opportunities for us if we handle them rationally. And periods of underperformance, periods when we will look dumb, and maybe our credibility will be tested, and your confidence will be too. We try to give you enough information so that you can make that judgment. So what you get in exchange for that is long-term outperformance. This works. You put your money in the hands of a team of people, 10 people in the investment team, obsessively trying to eliminate risk, trying to find where things are going to go wrong, and acting on it. So investing in things that we know very, very well, backing teams that we monitor very, very closely. And that's why you get this long-term outperformance. That's the low risk. We seek to avoid things that are likely to result in permanent losses of capital. Eliminates lots of potential investments. And then honesty and alignment. So we will talk openly about our mistakes, not because we're nice and good people, because we honestly do believe that in our mistakes there is learnings for us. That continuous improvement comes from being comfortable with errors and looking at them as a source of improvement and insight. And then alignment. We can't do well unless you have done well, and that's a little unusual in our industry. So why the investment trust? Why Aurora? We've covered all of this, but this isn't a recent thing. We've been applying Dream from the moment me and Charlotte put it together 26, 27 years ago, constantly refined, and we have the evidence to show what it does. High returns with what we would say low risk. We've had 1-0 in that whole period, and you see our loss rate is by value 7%. A particularly attractive time now to come in, upside 135, 155 on the shares, and we talked about the fee structure. And like I said, there is no other way to access Phoenix for an external investor than through the investment trust. And with that, we'll take questions.
Brilliant.
Thanks.
We've had a few questions come through, so just a reminder to use the Q&A function if you do have any. I'll try and get through as many as possible before we need to close off. So you mentioned Lloyd's a few times there in the presentation. We've got a question. Could you describe how your sell discipline might vary between holdings like Lloyd's, where ultimately returns may be capped compared to the potential in other stocks?
Working on thinking about how you sell something is something we've thought about quite a lot recently, because there's a lot more written and thought about on how you buy versus how you sell. And actually, even if you go into the human element about it, the feeling you get when you buy something and you're anticipating success is quite different from the biases that are likely to impact you when you're looking to sell something. But something like Lloyd's, I think there are kind of two variables there that really impact our perception of when it may be appropriate to sell. One is that it has a reasonably bounded market, so it's market leader in the UK, but it doesn't have a significant runway to expand either in its existing market or in our judgment, in other new markets. And it also has a management team that is focused and is executing on that, but doesn't have a range of opportunities to expand the businesses in ways that we wouldn't possibly maybe not be able to comprehend today. So if you were to combine those two observations, what it indicates is that the likely range of potential futures in Lloyd's is more bounded than it might be for say a company like Netflix. And now Lloyd's today trades at still a reasonably significant discount to our central assessment of IP. And so for those reasons, it isn't something we would be looking to consider. But if the price were to change, it's probably likely that our range of futures is not changing that much, and therefore it is one that there would be a price at which we may reduce the holding, and it also depend on our perception of other opportunities.
Yeah, I see that. That's very true. So we want to run long-term grades, and they have certain characteristics. One of them is the runway, but it is still possible for Lloyd's to turn into a long-term grade if it had a Brian Pittman-esque era where it even bounded. But at that time, Lloyd's was smaller and had more scope to grow. And at the moment, like Kartik said, it is bounded in how good it could be. And it's always interesting to see what managements do when they run out of runway. Quite often they make poor capital allocation and risk decisions. And that would accelerate our thinking about how much to have if we saw Lloyd's drifting off into other things, which obviously we've got some early signs that they are doing. So yeah, those all feed into the thinking.
Okay, good stuff. 30% of the fund is undisclosed. Isn't that quite a high figure? Is that perhaps why contributing to the discount? Because people are a little bit unsure about what they're buying and what's in the portfolio at the tail end.
I mean, we take a long time to make our investments, and the scale of the organization means the last few times we haven't managed to buy everything that we wanted to buy, and we think our investors pay for this. So until last year, where we made 3 investments, we've made 1 a year. So that's a huge amount of resource to make 1 investment a year. It might have taken us 10 years to make it. If we just publish it, people could just replicate the portfolio at the liberty of our investors. I mean, our investors will be paying for other people to have access to that. I'm not sure how much you learn by looking at our single stocks, and I don't know what you would do. I mean, you might want a DD whether we're doing what we said we would do, but we disclose when they go above 3%. We don't deliberately put them under 3%, but that's the point where we think we will be very open about it. And so we recently disclosed that we bought Wayfair, although it was a number of years back because it had passed that point. So no, that's where it is. I don't think it's got anything to do with the discount because it's always been the case, even when we were trading at a premium and issuing new shares. So I haven't heard that be given as a reason.
Thank you. Could you please elaborate on some of the details in terms of like the investment premise for some of the top holdings in Aurora, just to give a bit more of a feel for your approach in terms of some of those core holdings in the portfolio?
Yeah, sure. Maybe I'll do it maybe quicker than Gary.
Definitely quicker than Gary.
Maybe let me do Carcino and Fraser's, and if you want to comment on any of the others. But so Carcino is a separately listed company which Phoenix is both the investment manager of and the majority shareholder. But really, the key to understanding that asset is to look at Dignity. Dignity was previously a publicly listed company. It is the leading end of life business in the UK. So it operates funeral homes, crematoria, and has a large prepaid funeral plan business. In essence, we think the end of life industry is an attractive market because it will grow structurally for a long period of time. It is not cyclical, it's uncorrelated with most things in the economy. And within that, Dignity has a very unique business, which is vertically integrated through these different elements. And each of those elements, we think, and in connection together, produces a business that can earn very high returns. Dignity wasn't historically doing that because it was pursuing a strategy that we felt was destroying value. That has changed significantly recently, and so what we think you have there is a business that can be a market leader in end of life, and growth in that market is highly attractive because it comes at very high incremental margins. So we've written quite a lot about it, and you can look into it separately. But that is really a stable business operating in a growth market that has the potential to be a reinvigorated leader, and we're really highly confident of that. Frasers is a business that Phoenix has invested in since 2008. Frasers used to be called Sports Direct, and really there you have a couple of things. Is you have an exceptionally dominant sporting goods franchise in the UK. That's very verifiable. Any parent who's trying to order football boots for their children will find there are not many other games in town. But really, if you look under that, how that position has been built is really a remarkable story in entrepreneurship from Mike Ashley, who's built this machine that is effectively able to become the lowest cost operator in any retail segment that it operates in, which today is primarily sporting goods, and also a more nascent position serving luxury goods in primarily regional areas of the UK. So Frasers is a pretty extraordinary business because what it combines is a highly dominant retailing business that earns high returns on capital, but also with this exceptional entrepreneurial approach to capital allocation, which means it does do some unusual things. So it's got over 1.8 billion of property on the balance sheet, which is pretty unusual for a retailer. But when you combine that together, we think it's a very good place to have your capital over the long term, and it's very attractively priced.
Yeah, so those are like the investment cases, but the amount of work that we have done in terms of where does that confidence come? You know, we bought the whole company of Dignity. We had one of the team on the board. I even went on for a period as CEO, and then we came off the board and we took it private. We know the business incredibly well. In fact, every single one of those funeral directors have been visited by one member of the team here. So we have a huge depth of understanding about the business, and we have we have ownership, so we get to protect ourselves from poor management decisions, but we also get to select good management. Frasers. I think Mike would tell you that nobody understands his business better than we do. We're constantly mystery shopping and figuring out what's going on. But we've published a survey, unearthed the machine underneath. He's very conservatively accounted business. It is the only business I've seen in the UK that depreciates land. So it isn't always clear to everybody else, but underlying that is this incredible machine, capital, a fairly consistent 25% pre-tax, and very, very visible, because what it does is they're very, very monitorable and in the public domain. So to find the sort of value we look for, it's going to be slightly unobvious. The reason why it's going to be cheap has got to be obscured in some way. Yes, by either a crisis like Netflix was, or like Burberry. And so those are obviously good businesses, maybe, but they're going through bad periods. Or because someone thinks there's something else. People think house building is cyclical and has no pricing power, or they think Frasers is a retailer. And retailers are very rubbish, generally in business. And so we find value where it's not apparent, but we're looking for the same thing. The same, in the rough, it's a diamond that earns at least 15% on its capital.
Okay, very good answers. I mean, you mentioned Castle there as obviously the top holding in the portfolio at the minute. A question relating to the mention of buyback shares for the company if the market fails to reflect the value of its assets. And the market's still seems not to be recognizing that value. What still needs to be done in order for a buyback to occur or something similar to commence?
Well, we wouldn't flag that in advance. It's slightly different with a company like Arsenal to the trust. In Aurora, we do care about whether the discount is in the short term, not just in the long term, because we know people are transacting Aurora quite regularly, and so that we do have a buyback program in the trust, so that we can deal with excess sell. We don't have the discount widening. In Carsteno, it would be tactical. It would be a decision that was the best use of some capital that was available, and then we would act. But the shares performed quite strongly in Q4. Now the NAV's just jumped, but the NAV was £1 in Q3, and the shares went from in the 70s to 95, 96, and then it's gone to 112. And who knows where it will go. So it's more likely to be a tactical or a tender at some moment, rather than a feeling the need to maintain something. We view Carsteno more like a company. Most companies don't publish an NAV, and nobody pays attention to it. So, and at the moment, the value is all invested in the business. So it's not like there's loads of capital sat at the centre that we use for buyback. So. But yes, well, we wouldn't leave ourselves or our investors trapped in a deeply undervalued. We own the majority of it. So yes, we would do so.
Okay, thank you. Discussing, I guess, the stocks on a kind of target list outside of the portfolio that you have. How many AA stocks do you have that are within the 10 to 20% of share price targets that you would consider investing in?
I don't know. Don't quite think in that way. Maybe 10. Yeah, we don't. It's quite hard to become a double A. And the other thing I would say is it's not a straight, it goes down 20%, you buy, because usually things don't go down 20% without something happening. So you've got to see whether the thing happening changes your view of value. It could go down because there's been a fraud in the accounting department. You probably aren't buying it. So we have an idea of how much we would need for it to fall for us to invest, but we're not. I don't monitor that count. I'd have to do sort of mentally, but it's single digits. I think it's probably less than 10.
There's a few you've got your eye on there in the
Okay,
future potentially. Yeah.
Things that, but like if you think of a double A, that it needs. We checked it the other day. It needs to come back 85%. So some of them are quite a way away.
Yeah,
but it happens.
We've got one here regarding your use of AI in terms of the contribution it has for selection and your research process. Have you thought of partnering with any labs or specialists in AI, or is it implemented, I suppose, in-house?
And we have now added to the member of the team a CTO, actually. So we've built our own proprietary space where we are. We built some of our own agents. We want to showcase some things that we think we're happy to share, and some things where we think we shouldn't share. But it's used in every aspect of what we do. It really has improved productivity in a material way, and it's allowing us to do things that. So now when we sometimes want to do something, we'll actually build a piece of software. But it'll be a non-technical person, it'll be an analyst, build the software to do a piece of work, and as a solution. You would never have thought of doing that. So every member of the team has built their own agent to do some element of our work, looking for ideas, DDing ideas, or monitoring ideas, and then when we're trying to solve a problem, we'll go through Google reviews or Instagram things to see whether or not we can find any any signal in the noise that we can use for monitoring things. And then we've been using them in some of our Socratic process. So we've created some different personalities and introduced them into. So yeah, we're using it in everything that we do. Partnering, we're constantly looking around at stuff. Inside Castleknock, there's we have a VC operation in Phoenix called Iona Star. So if you look at what Iona Star does, it's backing data and AI startups. Kind of exposes us to some of the cutting edge that's going on in that space, and so it does give us a bit of an insight of what's going on, and some of that is reusable in what we're doing. So you could, I mean, I don't want to say anything that's not in public domain, but we'll do anything that we think makes sense. We're not, and we think AI is a huge augment. On the other hand, I don't think it changes the core central piece, which is having got all that data, can you figure stuff out? I can show you the Wetherspoons stuff, but most people weren't even monitoring Wetherspoons before, when you could just walk in. And investors don't seem to go like that. They rely on the results and they read the Bloomberg and stuff. So it's augmenting us doing something that we were the ones only doing before. We're asking those questions to feed into our process. And at the center, that methodology, that dream, that all sits there. And still, like I said, value investing is mainly miserable, looking stupid, doesn't appeal to people, bumpy and volatile. So AI is not going to take away any of those reasons, those biases that make it a successful long-term strategy. I still think it will appeal to the nation. If Buffett becoming the richest man in the world as a value investor didn't make it popular, then I don't know what will.
Also, I think just in the question, an important point we think here is to become proficient, which is so valuable in a tool. You've got to do it yourself. It's not something you can outsource because you want to understand the depth and power of a tool or its breadth and capability. Unless you do it yourself. I was listening to Dempsey Sala saying that he thought that users the tools might be more proficient than the builders because the builders don't actually have the time to understand their capabilities. So we're not outsourcing anything in how we're doing it. Yeah.
Okay, thank you. I'm conscious it's 3 o'clock, but we do have a couple more questions here. So yeah, I think we're happy to carry on for a little bit. In terms of concentration, what is the highest any single stock has got to in the portfolio, and how do you manage that in terms of, I guess, analyst feelings, behavioral finance as a fund manager from a portfolio manager's perspective, and just maybe comment on your biggest regrets or best lessons learned from that.
The biggest weights, if not thinking about Aurora, but thinking about the record, is we've got 40% a couple of times, not at cost, obviously, when they started running. Reuters coming out of its rally from 2003, when we were buying it at £1, and doubled up and doubled up. And when it reached 40%, and the same thing happened to Barrett, it reached about 40%. So coming out of 2008-9, when it ran, it got to 40%. So the way we think about those is when it gets above 20%, if the bottom of the range of outcomes is below the price, we worry. So people probably won't remember, but house builders bottomed in the first half of 2008, not Lehman's at the Bear Stearns moment. But actually, they went up sevenfold. Barrett did by the spring. So very, very volatile. Our concern was at the time when it was a big weight that in a potential double dip recession there would be a rights issue and we could potentially get diluted and lose money. And so we worked with the company once it emerged on the other side to do a capital raise, and that capped some of our upside, diluted some of our upside, but it reduced our downside enough for us to run. So coming out of 2009, when the stock went from £1 to £3.50, 40%. So when it reached the level, still below liquidation value, I started to switch into what I thought was replicable value. Tesco at £1.80, £2. And it wasn't. The better thing would probably have been to stay with the Barrett, but that's what we do. And the same with the Reuters. And it reached a point where actually there was downside. We don't want to be running 40% weights, potentially where there's a material downside. So we'll take some money off the table. And one of the lessons I learned from that is that in 2008, when it was really was Christmas, if you're a value investor and you were still alive and hadn't been redeemed to death, then we focused on just 2 holdings. And I thought I'd learned that concentration and get it right with more chance that you'd run the winner. And we invested in 2, and one was Barrett and one was HBOS Lloyd's. It took about 15 years for Lloyd's to make any money, and actually could have been 4. We rejected Rightmove, and if I looked at everything of the 10, 9 of them were excellent. The HBOS Lloyd's was not. So I think and my lesson is, if you want to be able to run a winner, it would be better to have 4 of those in those extreme moments, so they can all run for longer. They don't get into the 30 or 40% uncomfortableness is what's happened. So, yes. If you look at our post-COVID investments, there were 4 of those extreme ones: the Netflix, the Hotel Chocolat, and the Wayfair and the AO, and that reflects some of that thinking. Biggest regret is selling Games Workshop. We owned over 20% of Games Workshop. Between us and Nick Sleep, we owned half the company. There'd be a book about me by now if we just held on to that. And there was no reason to sell it. It's one of the dumbest things. It is the dumbest thing I've ever done in a long list of dumb things. I think that comes at the top. But it's always nice to be asked.
Yeah. You mentioned Barrett Redrow, as it is now. A question on your investment philosophy. Is it predicated on a normalized number of property transactions in any given time? And what gives you the confidence in this level rising over time, given the trade-offs between price and affordability, without price and returns also getting hit? And supply, mentioning that the supply seems less of a constraint at the present time.
It's not predicated on that. So it's predicated on a few things. So one is that humans will still form households. So given the population we've got, so all the Barrett customers that have to come are pretty much already there. They're all born. So we still have a view that household formation is fairly slow moving the way that it happens. And actually in the UK, it's suppressed. More people are living at home longer, more people are sharing than they would like to if they could afford not to rent. We assume that people aren't going to be homeless. They'd rather over-concentrate in a house. So if you have an undersupplied market versus households, you'll always be able to sell a property. And if you can't sell it to an owner-occupier, you'll be able to sell it to a landlord. That people won't opt to sleep in the streets. They will rent. And that's worked pretty well. We also rely on the fact that the land price will reflect the current house prices. And this is the big, this is one of the big sort of variant insights we have about house building. People look for pricing power on selling, well, they don't have any. It's very much set by the second-hand market. What they do have pricing power on is naming the price they'll pay for the land. So if there's a suppression of house prices, we think if you took house prices down 50% in the UK and Barrett went into sort of liquidation, you'd probably just about double your money from here, which is a pretty nice outcome for such a horrible outcome. But what happens when they come to buy land, they use the current prices. So when you get a drop in prices, yes, it will hit profits because you'll be using land that you bought 3 or 4 years ago, but that money will be saved in what you pay to replace the land. So if you're continuously going forward, that only works if you can sell the house. And like we said, we think we could clear the house. We've had a stress test, 2008. You can see what happens in an oversupplied market. It took 7 years in the US and Ireland and Spain. They all went into a downturn with more houses and households, and it was horrific. In the UK, there was no overhang by December 2008. So within 3 months of Lehman's, there was no overhang. They'd taken discounts, up to 50% discounts to sell to landlords, but that's because the landlords bought it because they knew they could rent them out. So nice apartment blocks like Echo in Leeds or something, instead of being luxury apartments, it became student accommodation. But we rely on these things, and then you can put your scenarios. More cash gets generated on a sideways or downward than growth, because growth goes back into land. So household transactions, ebbs and flows. We don't really think so much about that. The most housing transactions are for second-hand properties. The new build is really 1 million to 1.5 million, and only 200,000 of those are new build houses. So yeah, that's the axioms on which we rely.
Okay. Had a question on a previously owned holding, Diageo. What are your thoughts on the business and the wider alcohol sector as an opportunity today?
Yeah, it's very interesting. The thing that sort of affected my thinking about we don't invest in any industries that are in structural decline. So a lot of value, or I think what can become value traps, are in industries in decline, mainly because management don't accept decline. They don't just wind nothing down. And this is a bit extreme. That's not where I'm going with Diageo. But so the question mark I've had is, what's going on with alcohol consumption? Is there something going on? So in those kind of demographics, if you want a long range forecast of the future, look at the new demographics. Because for someone who's doing something at 35, 40, he might be doing it at 45, 50. But what happens to the 18-year-old who's never drank before? That might give you, 18-year-olds going to unis these days are actually still tending to open bank accounts where their parents bank. So that, and if they've opened their Lloyd's account now at 18, that's probably, they might have a Revolut or Monzo, but it's a nice, good predictor. But if that was changing, we would worry about it, but it'd be a very slowly. And it's the same with alcohol. So we've been worried about the younger cohorts drinking less. What does it mean? And so do you have structural volume decline? And then there are all these other health potential challenges. And I don't know if it's a growth space. And so that's a material challenge for the operators within it. So if it's not growth, we just won't invest. There isn't a price that we would invest. But it could be growth because it reinvents itself, zero alcohol and different types of drinks and premiumization. So we can change the view, but we ask the question a lot, and I love industries and stocks in these kind of states. I mean, it's likely to present an interesting opportunity if it genuinely is an opportunity. But at the moment, the thing breaking us is a proper understanding of what's going on structurally with alcohol, the alcohol beverage industry.
Just a question on frequency of trading around names. I guess it says, if you have such an edge from your depth of research, why do you not trade around the names a bit more?
If you look at what the objective of the monitoring is, it is not to try and detect short-term factors which might impact where prices go. It is meant to detect changes in competitive advantages or markets, i.e. things that will fundamentally underpin or ruin our assumptions for what is effectively a 10, 15, 20-year estimation when you're coming up with value. Now, that means we will see things where we can understand that you can see a delta between expectations and reality that might impact a share price. But fundamentally, the monitoring and the research is not something we would look to exploit in that way, and it's not why it's done.
And I learned a lesson, which I could have just learned from a couple of people, because I then saw it written afterwards. Phil Fisher, when he was 1987, just before the crash and stuff. Fisher was a 15 stock, 5 stocks, half the portfolio person. But he said he did a lot of tinkering, but he pretty much thought it added no value. And John Maynard Keynes, if you look in his diaries, Obviously, he traded everything, he'd done all sorts of things, but he came to look at his record later on, and he had this was a King's College fund, and he had a great alpha he generated, but he said it pretty much boiled down to owning a few of the right things, picking the right businesses and just letting them get on with it. And I did that analysis after 10 years for the first time, which he shared. And slightly disappointingly, all my tinkering didn't add any value, it actually subtracted value. I went through the portfolio every night on the bedside table and did all sorts of tweaking here and adding here, and a lot of time and effort, no value added. So we were very much the occasional swing of the bat when we get what Buffett calls the fat pitch, when everything aligns. And then just leave it be. We're invested in businesses. We're happy with the business, and we're happy with the management of that business, and it's performing well. Just let the business take care of itself. The money made for our investors mainly comes from the money that our businesses make with their shareholders' capital. We've just got to buy the right ones and buy them at the right price, and then the rest should take care of itself and take money off where we got it wrong.
Mm-hmm. Very good. How do you look to determine whether a lack of short-term operational progress is masking actual tangible progress? And could you give some examples with some underlying stock positions in the portfolio, or an example?
You don't want to be in a mistake a day longer than you figured out it's a mistake. But businesses unfold in a noisy way, and sometimes good management get things wrong. And so this is where culture can help. So if you've got the right culture, it'll figure its way through those mistakes, and you can have confidence that ultimately they'll get it right. So we do obsess about that stuff. We do look at it. But generally, if we've got it wrong, we're going to be late, because we'll have initially assessed and given the benefit of the doubt, and ultimately by the time we figured out that it's that we're wrong, then it's too late. I don't want to do any of the current portfolio because that's maybe price sensitive information. But we sold RHI Magnesita. We assumed it had pricing power. We had a couple of instances where it didn't seem to be reflected. If you have pricing power, then your margins should be more stable. Ultimately, changes in your input costs you can recover because you have pricing power. So when it doesn't happen, but it's because steel volumes are down and they don't want to pass it on to customers, you can understand it, it makes sense, you can make allowances, happens again, you're not sure, happens a third time. We made a mistake here, they don't have pricing power. We don't really want to own businesses. You can't get through the dream school if businesses' profits are really just a function of external factors. We want to own businesses that have some control over their economics. And we got that wrong in RHI Magnesita when we sold the holding. So it's really not straightforward. One of the benefits we've had from the casting and owning our own businesses and being inside them is we've got better at identifying what are the factors that you should look for, how you judge this stuff, how real business looks like from inside. But it's still not straightforward.
Mm-hmm. I think that's most of the stock specific kind of questions that have come through. I think it'd be appropriate just to end on a couple of questions with regard to the UK equity market in general. The first one is why is the UK equity market going up when the news flow is so bad? But I guess you could also link that in with another question that says the UK market is in the news and the press, a lot of expected flow coming from markets that look overvalued, such as the US. But do you see the UK equity market and actually relating to Aurora benefiting from some of those flows in the future?
I mean, if we accept that prices in the short run are a random walk, we'd be slightly foolish to try to comment on why prices. There's always a story behind why prices go up and down. I mean, I'll read a set of company results at 7 a.m., look pretty good, and then at 8 a.m. it opens and it's down 4%, and it's because expectations. So it's not the actual news; it's the news versus expectations. So to simplify the why is it doing well when the news seems bad. I'm not sure that it necessarily does seem bad, but if that was your take, then probably the expectations were that it would be worse. And maybe there's a change of that. It's a very underinvested in the areas that we know. We're not experts in all the stocks in the UK, only a few, but in the things that we own, extraordinary cheapness is what we see. What changes that, or when it draws the attention of either bidders or investors? Yes, there does seem to be a bit more US interest. We've heard that. Will AURORA benefit? I mean, it should benefit if that's the case. So people wanted to be able to benefit that. So we do think a bit of a pendulum swing is going on with the UK, because some of the good stuff that's happening is that unstitching of some of the damage of Brexit. So fixing some of that friction with our biggest trading partner. These are positives. Government credibility is building, which you can see in capital markets, and we may go through the worst of the tax raising piece of that. In our areas, like planning reform and stuff, some very material positive stuff is coming down the line, which will be good for house builders. But we're not really well equipped to sort of say UK versus US versus Europe, because that would suggest we're experts in those markets, and that's beyond us. But maybe Carter's got something smarter to say.
I don't, except I just point out it kind of comes back to how if you use that anatomy of a Phoenix investment, it kind of almost works at an aggregate market level. The UK market was went sideways for a very long period of time whilst cash flows grow. So the market's earnings yield was rising. The elastic was stretched, and that's why you can see that the narrative of the UK economy is weak. It's hard to reconcile against UK banks trebling and house builders being moribund. So it's just when elastic is stretched, it snaps back, but you're not sure when. In aggregate, you've just seen some of that releasing in the UK, primarily led by financials and miners. So
I mean, the UK bank, Lloyds, 25% of the market, number one, been through all those tests, all the rules that made them quadruple the amount of capital they had, and they can still make a 15% return, suggesting they've got pricing power. You could buy it for less than book. So there's a 15% yield in a market leader in a country. So 15% seems a very high return to get from quite a safe investment. So, I mean, it makes sense that people would want to buy it, to me, but I could make the same argument now about Barrett. And Lloyds went up and Barrett didn't. So this is not the place to come for forecasts, I would say, unless they were beyond 3 years. The UK is cheap, and over 3, 5, 7 years, I imagine you'll see some pretty achieved.
Last question, I think, unless anyone wants to type one in the next couple of minutes. Do passive fund flows impact adversely on the potential for AURORA to generate returns, given there's a lack of price discovery in the market, you could argue?
One of the most beautiful things about buying Burberry when we bought it was it gone out of the FTSE. There was an overhang of selling of people who were selling it purely for the reason that it wasn't included in the list. It didn't matter what they were making; they could have been making, bananas, but it was being sold because it wasn't in an index. So no, we love those kind of funds. They don't think. So occasionally they distort the market. More money into the things that have gone up the most, and less into the things that will down. So I don't think it does anything. Well, I mean, we're talking about outperforming the index. We're only making a few investments. There's a couple of thousand securities there. We're trying to avoid the things that would be obviously wrong, and occasionally find something that's like a very well handicapped, low risk opportunity to make a really good return, where we can obsessively watch it and protect your money. The index game is just something else altogether. So, what do you think?
I think the passive flows, if you think of, again, coming back to the anatomy, it's just distorting parts of the curve. It's making it sharper. It's making probably that trawling B to C part longer. But it's probably making the magnitude of changes and how quickly they're happening. It's probably accelerating that, because when there's a recognition of changes, maybe it's happening faster. I don't know.
One of my life observations, which is a little sad, is that value investors, like boxers, seem to go out on lows. there's a number of value investors, well, like comeback boxes being taken out at the moment. This is all, I mean, I hate to see that happen, but it kind of tells you what happens. A long run of this style not performing means people throw in the towel, and in that situation, cheap stocks get cheaper. And we've had that phenomenon going on for a number of years. Money has certainly not been going to value strategies.
Very good. Well, I think we're near enough there. There's no more questions that have come through from the audience. So thank you very much, Gary and Kartik. I don't know if you wanted to summarize the presentation or the strategy.
So we are unusual. We're not for everybody. We're probably not for most people, not people like the bumps and stuff. But I think if you take some time to look into what we do, it's a very safe place for your money. And just at the moment, it's a very attractive, extra attractive place for your money. So yeah, please take some time to learn a bit more about us. And what else?
That's well said. I think we're gonna, yeah.
Thanks, Nicholas. Thanks everyone for listening.
Thank you very much, Gary and Kartik. If anyone has any questions following the event, then please do email ir@frostroad.com and we'll try and get back to you and get an answer from Gary or Kartik. But for now, yeah, thank you very much for joining us and we'll see you again in the future. Thank you.